Saurabh, let's look at two stocks then. We've discussed HDFC Bank, the other one is TCS. You've owned it and you've liked it. Now, there seems to be a early recovery which you can look at IT. At least the managements are sounding confident that worst is behind us. So is HDFC Bank, which is a contra and a value buy, is that a better bet, or is TCS a better bet given that the industry now after 18-24 months of a gut-wrenching contraction is now turning?
So I think if you look at the two stocks, Nikunj, TCS and HDFC Bank, TCS's business has operating levers, but then this is not an industrial play. So TCS is an IT services firm. Operating margins are super healthy anyway, around the 25% mark. And yes, as the big order book, I think it's a $10 billion order book, as that comes through, the EPS growth, which has sort of gone down to low double digits, perhaps even single digits in some quarters, the EPS growth reverts to the long-term normal of 15, 16, 17%. And TCS therefore should have a good run as the Western economies recover over the last couple of years. What TCS hasn't had is a massive derating in valuations. HDFC Bank has had that. So with HDFC Bank compared to TCS, you're potentially looking at 20% earnings compounding and a re-rating, whether you use price to book or PE doesn't matter. So you get a double play on HDFC Bank, 20% underlying compounding in the business as opposed to say TCS is 16, 17% and a powerful re-rating. And therefore in our portfolios, the HDFC Bank position is much, much bigger than the TCS position.
Okay. How do you see 2024 being different from 2023? Largely because of macros and moving parts like inflation and interest rates.
So I think the first big difference is we are optimistic that the private sector capex story revs into high gear. Private sector capex really hasn't done much in India since FY19. All the heavy lifting has been done by government capex, which is roughly tripled by our estimates since FY19. Now, private sector capex plays are very different from public sector capex plays, and therefore, say in our portfolio, we have names such as RHI Magnesita, which is a play on the steel demand in India continuing to run up, and all the steel plants in India needing more capacity to be installed. Similarly, Grindwell Norton is a play on private sector capex. It's an abrasives provider. So the public sector capex providers would be, say, the public sector capex beneficiaries would be cement, EPC companies. They have had a tremendous run over the last couple of years. Our reckoning is private sector capex ka time aa gaya hai. The second areas, as we were discussing, IT services. We also own engineering R&D companies like Tata Elxsi and Tata Elxsi and LTTS. The ER&D companies and IT services companies have had a rough couple of years. As the Western economies recover over the next couple of years, we should see better numbers come through from LTTS, Tata Elxsi, Infosys, TCS, and so on and so forth. And the third area would be private consumption. Private consumption actually has been pretty weak in India. The latest GDP print, private consumption was growing at, I think, 3 or 4%, which is unbelievable in the Indian context. I reckon private consumption in India will pick up as the private sector jobs market and the interest rate cycle moves in the right direction. So consumption-related pays, we just discussed Avenue. Consumption-related pays in India have had a tough time over the last couple of years. Aisha alluded to the K-shaped recovery. I think several of those issues could be less painful in 2024 than they were in 2023.